Hello everyone, welcome back to your channel focused on trading. Today I am going to talk about an easy to learn and widely used strategy of trading, which maybe each one of you has used it before, but in this different video I will reveal some very useful tips of enter-exit points that will help you not to be confused within the market. But before going to the topic, I want to thank you all for supporting me by subscribing and hitting like buttons, and the ones who follow my vids but not subscribed since now hope that they find this channel useful and join our family, because lots of wonderful programs we will have in this channel. Now let's go straight to the topic. First, I want to give you an idea about what is exactly moving average and the difference between simple moving average and exponential moving average. Moving average is a calculation used to analyze data points by creating a series of different subsets of the full data set. As an example, a 10-day moving average adds up the 10 most recent daily closing prices and divides it by 10 to create a new average each day. And each average value is connected to the next, then creating the singular flowing line. Exponential moving average and simple moving average both measure the trends. However, some differences there are between these two measurements. The primary difference between exponential moving average and simple moving average is the sensitivity each one shows in the data used in its calculation. Simple moving average calculates the average of price data, while exponential moving average gives more weight to current data. The newest price data will impact the moving average more, while older price data have a lesser impact. Short-term traders may not care about which average is used, since the difference between simple moving average and exponential moving average is not that much. But on the other hand, when it comes to long-term traders, difference may be noticeable and traders care about. So by concluding what is said above, it's better to use exponential moving average rather than simple moving average, especially when your perspective is long term. Right now, what is triple moving average? Assume exponential moving average, which we talked about a few minutes ago. If we use three exponential moving average with different periods, then we can extend our triple exponential moving average strategy. Here we use 10, 20, and 50 respectively as the periods of exponential moving average. 10 is the fastest and 50 is the slowest one respectively. Our source will be close, as the close of candle is very important. The next most important point about this strategy is crossover, that we use as an alarm and also exit entry point. Here how it's going. Condition number 1, super bearish. When the candles are below the three exponential moving averages, an exponential moving average of period 50 is above the other two exponential moving averages, and also exponential moving average of period 10 is below all exponential moving averages, and the slope of all three is negative, super bearish market we have. In the picture, this condition clearly can be seen, and if you look, you will find out that half the market is strongly bearish in this case. Condition number 2, confused market. When the exponential moving average of period 50 is almost become flat, and the two exponential moving averages 10 and 20 are crossing the exponential moving average of period 50 to the above and below, and also cross over each other continuously. This condition when occurs, market get confused. Market has no idea to go which way, down or up. The better thing is that to get away from the market and do nothing. And finally, condition number 3, super bullish. If the candles go above the 3 EMAs, an exponential moving average of period 10 is above all, an exponential moving average of period 50 is below all respectively, and moreover the slope of the exponential moving averages is positive, then market is super bullish and it's time to enter the market. The three mentioned conditions above are the most common and important cases of triple exponential moving average strategy. Furthermore, I want to give you some tips about crossovers. How to know that the trend, whether up or down, is finished. How to find trusted entry point to the market. Both of these questions will be responded through crossovers. When exponential moving average of period 10 is crossing exponential moving average of period 50 to the above, it's a kind of super signal of entering the market, because the exponential moving average of period 10 reacts fast to the price changes and alarms us that market is going to go up. And when it happens reversely, I mean exponential moving average of period 10 is crossing over exponential moving average of period 50 to the below, a super bearish signal is ahead of us lying in the market. For all time frames, these principles can be used. Finally, I want to address a very important point about exponential moving average, which maybe you haven't heard before or maybe you did, whatever. Let me explain it via this picture. Look at these curves of exponential moving average here. In this range, the slope is positive here, but if we move forward to the top, we see that the slope is reducing and changing to negative, so ahead of that, price is pushing down. As it's clear, I think you got the point. When the slope of the exponential moving average curve is changing oppositely, it's an alarm of trend reversing. Not all the time this is true, but it's better to be cautious in that point. Finally, as the moving average is a trend follower indicator, I recommend that besides, use an oscillator indicator in combine with moving average or price action. That will be a kind of amazing combination. Hope that you enjoyed today's video and thank you for watching. Make sure to subscribe to the channel please and smash that like button. See you soon. Have profitable trades.